Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. 15 weeks ago I highlighted a bright pink July 24 to date rectangle pattern, which is currently 955 to 1097 on my daily chart. This pattern is still operational, even now. The top side for this pattern is also capped by the nearby 50% Fibonacci line of the May to August 24 move at 1098 and a 61.8% absolute Fibonacci line at 1106. Nearer term, the market over late April and early May had tried to stabilise over the November 2020 lows at 1045 and looked for a while like it might try higher, but 2 weeks ago prices pushed back down below it, pressing down through the mauve medium moving average currently at 1044 and the green short medium moving average currently 1045, as well as the congestion at 1033. But as I said last week, but further down is the slowly rising long moving average. That's now highlighted in gold and currently at 1028. And I quote further, which I suspect may be the next level to be tested, end of quote. This in turn proves to be the case, and after only 2 sessions of testing, prices turned back up over the November 2020 low, though I do see them pushing back below today. Interestingly, the green short medium moving average and mauve medium moving average, as well as the November 2020 low, seem to be better as a short-term support right now rather than a resistance. Above this low, we have a lot of congestion now, dating from early April that stretches from about 990 below up to about 1070, whilst below the gold long moving average, we only have the congestion down for the most part between mid-October 24 to mid-January 25, all in that 990 zone. Now a further feature, we have now a dark blue late December 24 to early April 25 bullish shift pitchfork. On this newish pattern, we are right now in between the lower time below, which is currently at 1008, and the middle time above, currently at 1073. Now, one other feature to be aware of, and it's something I've mentioned before, is that we had a monthly key reversal up for April. And whilst normally I would say that all things should be seen in the shadow of this monthly pattern, including any attempts lower, but looking this far distance from April, well, I suspect we may now see its force waning. Chicago soybean meal. 9 weeks ago, I linked the recent highs into a bright red downtrend, currently at 295.5. That is right now below the market. This also tied in nicely back then for a while with what was the descending gold long moving average, currently at 305 even. That was just about shadowing the downtrend. But a little higher up, though it's now flatlining. Plus also the green short medium moving average currently at 298.20. That was and still is mixing it with prices. And finally, as in the most recent instances, the mauve medium moving average currently at 302.10, which earlier had failed to provide much resistance above, now has energized itself as a resistance, and quite a good one over the last 5 weeks. However, 3 weeks ago we had a clear close over the bright red downtrend, and last 2 weeks has seen the market try to stabilize above this breached, possibly broken downtrend. The bears out there really relied on the overhead mauve medium moving average in recent days to cap the market's rise. This breach on the upside, in my opinion, is yet to be called a break higher, as I am not impressed with the show of any significant bullish incentive after the breach higher in trying to move even higher right now. Thus, all this impinges on my thoughts from 11 weeks ago as to whether the whole action this year has developed into a type of descending triangle pattern, possibly even a descending wedge pattern. The bright red downtrend, topside being the upper trend line, and the 290 zone below as the base of the descending triangle, and the earlier January to date purple lower trend line, currently at 285.10, being the lower trend line for the descending January pattern. The descending wedge pattern. For the future, I think a lot will depend on any move below 290 even to verify if it will be a descending triangle or a descending wedge pattern, or on any true break above the seemingly resistant overhead mauve medium moving average, and ideally over the flatlining gold long moving average just above that for any significant move higher. My major concern is that the same has been now for the last 11 weeks here, and is, as I warned back then and since, and I quote, possible false breaks here out of this proposed descending triangle pattern, end of quote. Now I should also point out that we are today once again within the previously highlighted 282 even to 300 congestion dating from between April to August 2020 and reprised back in August and November to December last year. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates now into 2025, and that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I've highlighted now for 105 weeks, yes, a full 2 years, and I quote, "And I only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and I've been living in the shadow of this pattern ever since," end of quote. I have also added ever since, and I quote, "If there's only one thing you take away from any of my musings, let it have been those words," end of quote. These last few weeks have shown that the shadow cast by a supremely significant pattern so long ago still darkens the skyline of this market today. Chicago soybean oil. The main pattern here, despite a breach on the upside 4 weeks ago, which has since been repaired, is still the bright red shallow bullish shift pitchfork with a mid-September to late December 2024 move. Prices this week have moved up despite yesterday's large action on the top side, which ended up as an immediate countering key reversal down and bearish engulfment pattern of all things. They are a little above the middle time below, which is currently at 46.48, plus the slowly rising mauve medium moving average, currently 46.68, and pressuring up through the rising green short medium moving average, which is currently at 48.31, plus the significant 38.2% Fibonacci line of the March 20 to April 22 move. Now, as I've said last week, a new pattern emerged over the last month or so, and one that I warned may kick off 2 weeks ago, and has actually done so since, though the break has not fully stabilized as yet. It is a dark blue start of April to end of May ascending expanding wedge pattern, currently 48.90 to 55.23. This had the requisite number of touches on each side, and late 2 weeks ago had a brilliant breach and break lower, dropping down through the significant 38.2% Fibonacci line, the green short medium moving average, plus below the mauve medium moving average and the bright red middle time, though not closing below that. I said last week, and I quote, "Clear consecutive closes below this dark blue lower trend line, and I would feel obliged to lay out potentials and even possible targets below for this pattern, something I'm not confident in doing just yet, as I fear a possible false break lower. I can only emphasize something I said only 2 weeks ago, so that's now 4 weeks ago. And that was, and I quote, "It wouldn't surprise me to see some sell stops situated a short distance below this 38.2% Fibonacci line," end of quote. Oh, sorry, it still carries on. "I think today we have seen those sell stops being triggered once again," end of quote. Well, last week I felt obliged to lay out some targets below for this pattern. Arguably, the market has already reached a pretty easy primary target at 46.03, but we still have a secondary harder to achieve target X down at 45.03 at the 2014 high below, and a tertiary much harder to achieve target X1 down at 43.74, where the 50% absolute Fibonacci lives. These are quite big targets to achieve on the downside, and since last week they started to seem, well, unlikely. I'll keep them on for a while at least because of my conservative nature, I suppose, but I do note how yesterday's actions seem to be some participants trying to see if there were any significant buy stops over the 38.2% Fibonacci line to trigger, and finding there were really none. Nevertheless, keep a close eye on that level, as there might be some delayed stops by 24 hours. But watch the action there nevertheless, as they may dictate the immediate future of this market. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences, Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.